One of them looks just like the page that we had yesterday. Up at the top, it's entitled Balance Sheet Accounts. Okay? And then there's a second one that looks very similar that up at the top says Earnings. Do you see that? Earnings Expense Account. So you should have two of these. First account in the balance sheet is going to be the bank account. Got to have a bank account. This account's going to sell to customers on account, so we're going to need a accounts receivable. This is also business is going to sell contracts to the bank, so we're going to have a contracts in transit. Going to have to pay first and last month's rent, so we're going to need what? Prepaid deposits. We'll skip over that next T account, and it's going to sell products, so we're going to need an inventory account. Only fixed asset account will be furniture. I'm not going to have a company car or building or anything like that in this business. Over in the liabilities, we'll have accounts payable. We'll have flooring payable. Sales tax payable. FICA payable. Federal withholding payable. And state withholding payable. Again, I recommend that in the liability side, write small. Okay? In a couple of those accounts, there will be several entries. Okay, under the accruals, what account will we have? That's right, accumulated depreciation, furniture. The capital account, this is a proprietorship, so we're going to have an owner's investment. We're going to have earnings. And we'll have what? Owner's drawing. Okay. Now this is where it's different from what we've been doing so far. We're not going to enter any transactions into earnings for this practice set. Nothing's going to go into this T account here. If you are tempted to enter anything into earnings, you refer to page number 2. Okay? Page number 2 is going to take all the earnings entry because it's going to give us more detail and a better breakout. So let's pick out the second sheet that says up at the top, earnings and expense accounts. And let's title that. Over on the right-hand side of this, we have our sales and cost section. Okay? This company sells furniture and appliances. So we're going to have one account called furniture sales. And that's going to be our first sales account. And the next account underneath that, just so that we can keep them close to one another, is going to be cost of sales furniture. We also sell appliances, and we want to break that out as a separate account. So we'll have appliance sales. What else do you think we'll have? Cost of sales appliances. And then unlike many furniture dealers, we charge for delivery. So we'll have a delivery sales. We're better. We can do that. Okay, and under other income, we'll just have an account called miscellaneous income to pick up all the incidental, small, little, occasional monies we might pick up that are unusual, that we don't need to have a separate sales account for. Okay? Now, over in the expenses, we're going to have several different expenses because we want to keep track of our expenses in different ways. Typically, expenses are just sorted alphabetically. That's generally how they're done, okay? And so the first expense we'll have is advertising expense. So on the left-hand side, in the first T account, write advertising expense. The second account is depreciation expense. The third account is interest expense. Fourth account for this business is payroll taxes expense. Now, what goes into payroll tax expense? Do you remember? We mentioned that just a minute ago. The employer's portion of FICA and unemployment, state and federal unemployment taxes go into payroll tax expense. By the way, those are all defined in Chapter 6. You might have noticed those when we were looking in there, so you've got a reference to refer to. Okay, payroll tax expense is number 4. Number 5 is rent expense. Number 6 is salaries expense. The next one is telephone expense. And the last one is utilities expense. As you might recall from the earlier example with City Cycle Company, we could have a lot of expenses, couldn't we? And the expenses are determined by what you want them to be, what you think will be most beneficial for the company. If typically, you only buy postage to send out the bills and it's only a few bucks a month, you probably don't want to have a postage expense. You'll just call it office supplies expense, or you'll include it in with miscellaneous expense or something like that. But then, if you start this major mailing campaign and you start mailing out a lot of stuff and postage becomes a significant item, you might want to create a new expense account called postage expense so you can track that. So that's how over time, sometimes these expenses get quite voluminous. And there's a lot of them because we'll find more and more things to track. Okay, now on the, let's look at these accounts. Furniture sales, do you expect that to be a debit or a credit account? Credit, okay. So let's just circle credit there to remind us that. Cost of sales, do you expect it to be a credit or a debit account? Debit, so circle the debit there. So appliance sales are going to be a credit. Cost of sales appliances are going to be a debit. Delivery sales are going to be a credit. What about miscellaneous income? Credit, so maybe circle that just to remind ourselves that that's what we expect. We know that there could be an exception, right? There might be an exception on occasion, but most often those are the sides they're going to appear on. What about expenses? What do we expect to be, debits or credits? Debits, so let's just circle those. Remind ourselves that that's where we expect it to be. You won't have to do that in the future, but this first time through it might be helpful for us. Okay, just like earlier, we are going to go through each of these transactions as a group and give you an opportunity to tell us what you did. So let's start with the first transaction. Invest $30,000 cash in the business. Okay, Estella, what did you do? The bank account. We're going to debit the bank account, $30,000. Now, where'd that $30,000 come from? Owner's investment. So we're going to credit $30,000 to owner's investment. Okay? So debit the bank account, credit owner's investment. Right? Okay. We also got to establish some more assets. Number 2, we buy $10,000 in inventory on a 30-day account. Okay, Ed, what'd you do? No, this is on a 30-day account. We're not paying for it yet. Good. Okay. Good. Okay. So we're going to debit inventory, $10,000, and we're going to credit accounts payable, $10,000. Okay. Good. Number 3. We bought $10,000 in inventory on a flooring line of credit. Okay, again, think about what did you get? Where did it come from? We bought $10,000 in inventory on a flooring line of credit. We didn't pay for it. Well, we got it. We'll have to pay for it later. Okay, Sini, what'd you do? Good. What'd you do to inventory? Debit inventory, $10,000. Good. So debit inventory, $10,000. Credit flooring payable, $10,000. Number 4, we wrote a check for an additional $10,000 in inventory. Now this we did pay for. The other 2 we haven't paid yet, but this one we paid for. We wrote a check for $10,000. To buy more inventory. Okay, Rhonda, what'd you do? Good. Very good. Debit inventory, $10,000. Credit the bank, $10,000. Okay? Now we've built up our inventory. Let's do something else for fun. Number 5. We got to pay the landlord to get in here, so we're writing a check for $3,000. $1,500 is a deposit. It's the last month's rent. Okay? And the other $1,500 is for this coming 30 days, this month's rent. Okay? So we're actually, it's the first and last month's rent. The total of the check is $3,000. Now this is where we're going to christen that second sheet. Okay? We wrote the check for $3,000. It was for 2 things. One was a deposit for the rent, and the other one was to pay this month's rent, which we are consuming. Okay, Harleen, what'd you do? So you credited the bank $3,000. And you debited prepaid deposits, $1,500, which is an asset account, right? Now, why is it an asset account? We haven't used it yet. It hasn't been consumed. We haven't gotten the benefit of that $1,500 yet. When will we get the benefit? Yeah, either it will be applied to rent the last month of our lease, or we'll get it back in a check, so it becomes like a receivable. So it's still an asset, but then the other $1,500 is used up. It's this month's rent. It's consumed, and so we're going to debit rent expense $1,500. Okay? Now, if we ignore the second page and just look at this page, will it balance? No, because we got a $1,500 debit over on the other page. So we're going to have to link those two together at the end of this. Right now, there's nothing on this page for that $1,500 debit that we put in that other account. Okay? Okay, number 6. We brought a desk and chair valued at $2,000 from home and put it in the office. Okay? So it was our personal desk and chair at home. We are giving it to the business, and it's valued today at $2,000. Okay, Dean, what'd you do? Good. Excellent. Okay. Debit the furniture fixed asset account, $2,000. Credit owner's investment, $2,000. Doesn't matter if it's cash or inventory or fixed assets. Whatever the owner puts into the business is an owner's investment. Okay. Number 7. We need some more furniture in the office to use, and we have some furniture out on the showroom floor that looks good, so we're going to take the price tag off of it. It costs us $2,000, and we're going to put it in the office to use it. Okay? So think, what did we get and where did it come from? Okay, Josie, what'd you do? We're not paying anything for it, so we're not going to credit the bank account. Where did we get it from? Where did it come from? It was inventory, wasn't it? We were going to sell it, and we decided to use it, right? So we're going to take it out of inventory, correct? Are we going to? Yeah, in a sense, we did that without paying any cash. Okay? So, Josie, are we going to debit or credit inventory? To credit inventory, $2,000. Okay? That's number 7. Okay, and what did we get? That's the credit. What's the debit? What are we going to use this inventory or this furniture, Josie? Right. Okay? So we're going to debit furniture, fixed asset account. Okay? So now what we got, how much furniture are we using? $4,000 worth of furniture, right? Okay? $2,000 of it came from the owner's home, $2,000 of it came out of inventory. They're just different sources. We got $4,000. Where did it come from? $2,000 from inventory, $2,000 from the owner's home. Okay? Does that make sense? Okay. Number 8. Oh, all right. Our first customer. It's great. I'm so excited. Okay, so we're going to sell some of the furniture. There's a reason why we're here. Okay, so number 8 is to sell. Now remember here, this is even more important that you remember to break it out into 2 pieces. Because now we've got twice as many accounts, so it can get even more muddled in our mind if we don't use some system in doing this. So first record the sale and then record the cost of the merchandise. So what do? We sold the furniture for $3,000 plus we had to charge $200 sales tax. So the customer gave us $3,200 that we put in the bank. Okay? Now record that $3,200 first, that deposit. Record that first. And then worry about the inventory as a second part to the entry. Okay, tell us what you did. Okay, so that's a debit to the bank account for $3,200. You made a deposit. Okay? Okay, now you're close, very close. But not all of it was a sale, was it? Yeah, you're very close. What's the $200? Very good. So we're going to debit the bank account $3,200. We're going to credit sales tax payable $200, right? And we're going to credit then, as you mentioned, furniture sales for $3,000. Okay, does that balance? We got a debit for $3,200. We got two credits adding up to $3,200, right? Okay, so that's the first part. We want to take care of that first. Now we've got to record the inventory or loss of inventory. So, Kathy, what did you do there? The cost was $2,000, so we're going to credit inventory $2,000. Well, that's how much we sold it for. It only cost us $2,000, okay? So we're going to credit inventory $2,000, and what are we going to debit? Cost of sales. So we go back to that second page, and we debit the cost of sales, $2,000. Okay? Now let's look at what happened. From that sale, our sales went up by $3,000, didn't they? But our cost of sales went up by $2,000. And that's going to actually reduce our profits, right? So our net profit or earnings is how much after you enter that sale? $1,000. Isn't that what we want it to be? Okay, good. Did that second part balance? We credited inventory $2,000. We debited cost of goods sold $2,000. So we're still in balance. Questions on that? Yeah, the earnings, these two accounts right here are in earnings. Yeah, all these accounts make up earnings, okay? And will be the net effect of it when we get done. Okay. Number 9. We're going to sell some appliances this time for $2,000 plus add $200 in sales tax. The customer is going to pay us the $2,200 in 30 days, so we're not getting cash now. He's simply promising to pay us the $2,200 in 30 days, okay? The cost of those appliances was $1,200, or $1,500, excuse me. The cost of the appliances we sold for $2,000 is $1,500. Tammy, would you tell us how to do that one? Debit accounts receivable, $2,200. Good. Okay, do the first part. Would you break it into the two parts? So tell me what you got $2,200 in promises. What's the credits? Good. Credit sales tax payable, $200. Very good. And so we go to the second page, the earnings page, and we credit appliance sales for $2,000. So far we balance, okay? Now, tell us the second part of that for the $1,500 cost. Credit inventory for $1,500. Good. And the debit, the cost of sales, $1,500. Excellent, okay? And what's the net effect to earnings? $500. Okay, sales went up $2,000, but cost of sales take it back down $1,500. So the net effect is $500. Okay, good. Okay, appliances were among that inventory that we floored. Okay, so it's one of the items that we sold. And so we have 24 hours to pay the check, write the check for that, right? So number 10 is to write the check to pay off the flooring for the sale in number 9. Now this is kind of tricky the way it's written. So I want you to look at this. It's saying prepare a check to pay off flooring for the recent $2,000 sale in number 9 above. Okay? Now we're writing a check to pay it off. I want you to go ahead and make the entry to write the check to pay it off. Yes. Yeah, question. Carol asked a very good question. Do you have to pay it off even though you don't have the money? Yes. If you allow your customers to buy it on credit, that's your choice and that's the risk you take. The bank isn't party to that decision, so they require payment within 24 hours whether you have the money or not. And if we didn't have the money, we probably shouldn't extend that credit. Okay, Dixie, what'd you do? Credit the bank account $1,500.
And then debit for your bill.
Very good. 10. Credit the bank account $1,500. Debit flooring payable $1,500. Thank you. Let me just mention this. So what happens here is that the bank, every time they wrote a check to pay off to buy flooring on these appliances, they added a list or created a list of all the serial numbers of all the appliances they bought. And then on occasion they come down and check to make sure that that stuff's there, right? So when we pay it off, we're going to write that check for $1,500 and we're going to identify the serial number on the stub. And we're going to mail it to them. And when they get that, they're going to look down their list and they're going to cross through that one and say that one's paid off. So read through this with me. We sold appliances for $6,000, plus we added a delivery charge of $500, plus we added sales tax of $300. So, total bill is how much? $6,800. We received $1,000 in cash, and they signed a contract for the balance of $5,800 that we are going to sell to the bank. Okay? So we got two different things. We got cash and a contract, right? Where did it come from? Came from three sources, right? Came from a sale, sales tax, and deliveries. Okay? So record that first. And then worry about the fact that the inventory cost us $3,000 that we sold. Now take your time on this. I'm not going to rush you. Okay, Tina. Tell us what you did.
Debit the bank account, the $1,000 cash.
Debit the bank account, $1,000. Debit contracts in transit, $5,800. So we have $6,800 in debits. Okay. Credit sales tax payable $300. Credit appliance sales $6,000. And credit delivery sales $500. So we've got $6,800 in credits. Let's go through that. I'm going to try to put these on the screen together. Hopefully it won't confuse you. But we debited the bank account $1,000. We debited contracts in transit $5,800. Those are the two things we got. Now where did they come from? Well, $300 came from sales tax, so we're going to owe that to the government. $6,000 came from appliance sales, and $500 came because we agreed to deliver it for them. Okay, so $6,800 in credits. Everybody with me right now? Okay, Tina. Now finish it up for us.
The cost of the appliances was $3,000.
Uh-huh.
Debit. The cost of sales.
Okay, so we're going to debit cost of sales $3,000. Okay?
Inventory credit, $3,000.
And we'll credit inventory $3,000. So we're recognizing that we're taking it out of inventory and we're going to charge it to cost of sales. We're going to debit cost of sales. That's as tough as they get. Right there. That's as tough as they get. Okay? It's as challenging as it gets. And you'll see that as we work through. Now, some people struggle with payroll, but I think you've got payroll down pretty well. But if you remember to break a sale of merchandise out into two parts, it makes it a lot easier than if you try to do it all at one time. The other thing I wanted to mention on this too is, I mean, if you look at most of the sales that you deal with, they're cash sales or accounts receivable. They're more like the easier sales we've dealt with, where you only have cash and where did it come from? You made a sale. That's what 90% of the sales you run into will be like. It's just in these more sophisticated kind of businesses where they're selling expensive merchandise that it gets more interesting. Okay? If you will just remember that process, record the sale first and then the cost of the sale. Let's do one more and then we'll take a break. Number 12. This also was one of the items that we had on flooring, so we need to write the check to pay off the flooring. It's number 11. So remember that one thing. We're going to write a check to pay off the flooring on that transaction we just prepared. Okay? Okay, Richard, what'd you do? Good. Credit the bank account $3,000. Uh-huh. Very good. Debit the flooring and payable account for $3,000. Now, how much do we owe to the bank after making this entry? What's that? $5,500. Yeah, we started owing him $10,000, but we have paid off $4,500 worth of flooring, so we only owe $5,500 now. And they have a list there in their office, as well as we probably have a list too that shows us which serial numbers are floored. Good. Okay. Number 13, we're going to pay our employee. Our first employee has a gross salary of $1,500, $200 in FICA is withheld, $200 in federal, and $200 in state for a net check of $900. So make that entry in. Gross salary of $1,500, FICA of $200, federal of $200, and state of $200 for a net check of $900. Tell us what you did now. Yeah, Kathy? Okay, salaries expense. How much? $1,500. Debit or credit? Good. Debit salaries expense, $1,500. Now why? Why not $900? We just paid him $900. Why not $900? What's that? That's right. It cost us $1,500. We just didn't have to pay him $1,500. But hold on a second. I think you're close. But go ahead, Kathy. Tell us the rest.
Then a credit to the bank for $900.
Credit the bank account $900. Good. Okay. Credit $200 for FICA. Good.
Credit $200 for federal.
Okay.
And credit $200 for state.
Uh-huh. Does that balance? Yes, it does. Let's look at that real quick. We got $1,500 in debits to salaries expense, right? We got a $900 credit and three $200 credits for a total of $1,500 in credits. Does that work? Okay. Now, I know where I think some of you were misled. You broke the $1,500 out between payroll tax expense and salaries expense, right? But whose payroll taxes are these? Are they ours or are they employees? They're the employees. This payroll tax expense is only for our share of the payroll tax. So the employee cost us $1,500. That's how much, in essence, we are paying that employee. It's just we have to withhold part of the taxes on that employee's behalf. Okay? In essence, he or she is paying it. We're just withholding it and paying it on that employee's behalf. Exactly right. Okay, does that make sense? Okay. We got another employee. And he heard that the first employee got paid, so he says, I want to get paid. I'm going to tell them to keep a secret, and they just can't do it. Okay. The gross salary of the second employee is $1,000. We're going to withhold $100 in FICA, $100 in federal, and $100 in state, leaving a net check of $700. Gross pay of $1,000, withheld $100 in FICA, $100 in federal, and $100 in state, leaving a net check, payroll check of $700. Okay, Sandy, what'd you do? Good. Debit salary expense, $1,000.
I credited $200 to the tax and $5,000 in federal and state.
You mean $100 to each of those?
Yeah.
Okay. You credited $100 to FICA tax, federal tax, and state withholding tax, all payable accounts, okay?
And then I credited the checking account.
Good. Credit the bank account, $700. Okay, does that balance? Got $1,000 in credits between these four accounts, and we debit a salaries expense for $1,000, so that balances. Okay? Number 15. Now we're going to write a check for $100 to pay unemployment compensation tax. Whose burden is unemployment compensation tax? Is it the employers or the employees? Employers. The employee does not participate in unemployment compensation tax. So we're going to write the check for $100 to pay it off. Okay, Nikki, what'd you do?
I think I got this. And it's payroll tax expense.
Good.
It's a $100 debit.
Okay, we're going to debit payroll tax expense $100.
And then we're going to credit the bank account for $100.
Very good. Credit the bank account $100. Okay, debit payroll tax expense. That's what we got. Okay, it was our burden, so it's a payroll tax expense, and we credit the bank account because we wrote a check for it. Okay. Number 16, also related to payroll, is we need to establish the employer share of the FICA. So we've got to match that. We've got to match what we withheld from our employees. Now, we're not writing the check. We're simply recognizing that we owe it. How much more do we owe than we've recognized so far? $300. So make the entry to record the employer's matching share, the employer's portion of that FICA tax. Good. Credit FICA payable $300. Credit FICA payable $300 and debit payroll tax expense $300. Very good. Okay. Now, how much have these two employees cost us so far? Lots of money. We got $2,500 in salaries and another $400 in payroll taxes so far. So we're up to $2,900. There's a couple more taxes we haven't even considered yet. We wrote a check to pay off the electrical bill. We wrote a check for $200 to pay for the electricity. Okay, Carol, what'd you do? Very good. Credit bank for $200 and debit utilities expense $200. Okay, everybody there? Okay. Number 18. We received an advertising bill for $500 and a telephone bill for $100. Two separate bills that we don't have to pay until next month. So we're not going to write the check right now, but we do need to recognize that we owe them. Okay? So we received an advertising bill for $500 and a telephone bill for $100. We've consumed it, it's used up, we just haven't paid it and won't pay it for 30 days. Okay, Michael, what'd you do?
I credited my accounts payable $600.
Okay, for the total of both of them, Okay, let's go through that again. We credited accounts payable liability account for $600, showing that we owe it. We debited telephone expense for $100 because we've consumed that, and we debited advertising expense for $500 because we've consumed that. Okay, good. That balances. Number 19. We received received a bill for $200 for flooring interest. We also plan on delaying that by 30 days. So it's not due for 30 days. We're going to recognize that we owe it, but we're not going to pay it for 30 days. Okay, it's used up. We owe it. It's consumed. $200. Do we have a volunteer? Tammy, tell us what you did. Good. Credit accounts payable for $200. Okay, now why? Why didn't you credit flooring payable? Very good. Excellent. Its terms are 30 days. What are the terms for flooring payable? 24 hours after you sell it. Okay, excellent. Okay, so you credited accounts payable $200, and what'd you debit? Excellent. Okay, and debit interest expense $200. Good. Number 20. Each month we're going to depreciate our $4,000 worth of furniture for $100. So we're going to increase the depreciation every month or add another $100 to the past depreciation accumulations. Just for 1 month. So this is just 1 month's entry for $100. Entry always looks the same. Volunteer. Dixie. Debit depreciation expense for $100. Good. And credit accumulated depreciation $100. Good. Questions on that? Okay. Entry always looks the same. Credit accumulated depreciation, debit depreciation expense. Every month we're going to do that. We're going to make that same entry. Okay, number 21. We received $30 commission for the soft drink machine in the lobby of the store. It's just one of those incidental things. Every once in a while we get something from something, you know, and this is every few months they'll send us a small little check for the pot machine, a commission on that. And this month it was $30. We put it in the bank, deposit it with the others. Volunteer. Okay, Joanna. Debit the bank account for $30. Uh-huh. Very good. Credit miscellaneous income, $30. Okay. Now, if we had a lot of pop machines and we made a lot of money from those pop machines, should we have a separate sales account for commissions on the pop machine? Yeah, yeah. And right now it might be a small item, but maybe in 6 months from now we've added 3 more pop machines, and now it's a big item, and so then we'll create a new sales account for it. Okay? So right now it's miscellaneous. Okay, those are all the transactions this business has, but we have to go through a process now to pull it all together. It's not as easy as it was before. The same process used, except for now we've got this whole other page. We've got to tabulate the net earnings or the net profit before we can balance the balance sheet. So we're going to go down each of the sales, costs, and expense accounts, and we're going to carry a balance over. Furniture sales. Our total furniture sales for the month was $3,000. The cost of those sales was $2,000. Now, I suggest you put brackets around that $2,000 to remind yourself that we're going to subtract that number. Appliance sales, we have $8,000, and we have $4,500 in appliance cost of sales, so we're going to put brackets around the $4,500 to remind us to subtract that. Our delivery sales were $500, and our miscellaneous income was $30. Would somebody add that column and write the total down under gross profits? $5,030, okay? Good. Now, where it says gross profits here, I want you to write this down. Gross profits equal sales minus cost of sales, okay? That's a definitional word. Gross profit is sales minus cost of sales, okay? So that's what that $5,030 is. Now let's go over to the expenses. We have advertising expenses of $500, depreciation expense of $100, interest expense of $200, payroll tax expense of $400, rent expense $1,500, salaries expense $2,500, telephone $100, and utilities $200. Could somebody add up the expenses for us? What do we have in expenses? Anybody got that? $5,500. Write that down at the bottom here where it says total expenses. Then I want you to transfer that up to the right-hand side, bottom corner, where it shows less expenses. Put $5,500 in there. Okay? And so we had $5,030 in gross profits. We're now subtracting $5,500 in expenses. What is our net profit? It's a loss of how much? $470 after all that. A loss of $470. Now, it might not be bad. This is our first month. We might have expected to lose a lot more than that. This might be good news for us. I don't know. Now, as long as next month's better, okay? That's what we're going to work for. Okay, now I want you to write then down under net profit, and this is kind of a given, but next net profit then is gross profit minus expenses. Okay? So gross profit is the sales minus cost of sales. Net profit is the gross profit minus expenses. Now another term for net profit equals earnings. We have to do this process. We have to first arrive at the net profit or earnings number before doing the rest. Once you've got that number, let's go back to the balance sheet accounts. And now, you must do this. If you don't do this, you won't balance. Where it says earnings in the capital section, put $470 with brackets on it. We have to show the net profit in the balance sheet or else it will not balance. Okay? And the net profit is a loss of $470. Okay? In the capital section where it says earnings there. Okay? So that's, now we've just brought one number over to the balance sheet. It's a summary. Okay? By the way, you have just prepared your first income statement. Here it is. An income statement is just a summary of the sales, giving the balances for each of these accounts. So this is not the traditional format of the income statement. You saw that a few minutes ago when we looked at Stewart's Bakery. But it gives the same information. And it totals down here to the net income or loss at the bottom. And that's what will show up in the balance sheet in the capital section where it shows earnings or net income or profit and loss, whatever the title is for that. Go ahead now and balance the balance sheet just like you have done before.
Complete this exercise by totaling each general ledger account on the balance sheet page, then add the assets, and balance them to the liabilities, accruals, and capital accounts.